Is Dave Ramsey's 4% rule really the best strategy for your retirement? Could following his advice actually put your financial future at risk? In today's video, we're diving deep into why Dave Ramsey might be wrong about the 4% rule and what that means for your retirement savings. If you've ever wondered whether you should trust the traditional financial advice or if there's a better way to ensure your financial independence, this video is for you. Stick around as we break down the flaws, the risks, and the potential pitfalls of relying on outdated financial strategies. Alright, let's jump right into it. The problem is when you go down these nerd rabbit holes in Reddit threads with folks who live in their mother's basement with a calculator. They spread ideas that make people think, I don't have enough money. It's hopeless. I'll never be able to save enough to retire. But here's the thing. Dave Ramsey claims that $1 million should create for you an $80,000 income annually. Is that really true? A 30-year-old person recently called in saying he feels close to financial independence. He's using the 4 to 5% rule based on an article he found on Dave Ramsey's own website. But then he saw George Camel's video suggesting a 3% withdrawal rate for a 30-year runway. Let's dissect this. First off, George's 3% withdrawal rate is causing confusion. Dave Ramsey firmly believes that a 3% withdrawal rate is absolutely wrong. He argues that you don't need such a conservative rate and implies that it should be more than 4 to 5%. But why does he believe this? Let's break down Dave's 3 dangerous assumptions. Assumption 1. High-risk asset allocation. Dave Ramsey's first assumption is that you should invest 100% of your retirement savings in stocks. While stocks have the potential for high returns, they also come with significant risks, especially as you near retirement age. A market downturn can drastically reduce your savings, leaving you with less money when you need it most. Diversification, which involves spreading your investments across various asset classes such as bonds, real estate, and cash equivalents, can help mitigate this risk. By relying solely on stocks, you expose yourself to the full volatility of the market, which can be particularly damaging during economic downturns or recessions. A balanced portfolio that includes a mix of assets can provide more stability and protect your savings from severe market fluctuations, ensuring a more secure retirement. Assumption 2. Outperforming the S&P 500. Dave Ramsey's second assumption is that you'll be able to outperform the S&P 500 consistently. Historically, the S&P 500 has averaged around 11.8% returns, but this includes periods of significant gains and losses. Expecting to consistently outperform this benchmark is overly optimistic and can lead to unrealistic expectations for your retirement savings. Many professional investors and fund managers struggle to beat the market, and the average individual investor is even less likely to do so. Betting your retirement on the hope of outperforming the S&P 500 sets you up for disappointment and financial shortfall. It's safer to assume a more conservative return rate that aligns with historical averages, thereby avoiding the risk of overestimating your investment growth and facing potential shortfalls in your retirement funds. Assumption 3. Linear 12% return. The third assumption Dave Ramsey makes is expecting a linear 12% return on investments. This does not account for the sequence of returns risk, which can have a significant impact on your retirement savings. The sequence of returns risk refers to the order in which your investment returns occur. Negative returns early in retirement can deplete your savings faster, even if the average return over time is positive. For example, if you experience a market downturn in the first few years of retirement, it can be challenging to recover, even if the market performs well later. This is because you're withdrawing funds to cover living expenses, leaving less money in your portfolio to benefit from future gains. Therefore, assuming a consistent 12% return is unrealistic and can lead to underestimating the amount you need to save for a secure retirement. Example of sequence of returns risk. Investor 1 experiences a minus 15% return for the first 2 years, followed by a 6% return for the next 16 years. Investor 2 has a 6% return for the first 10 years, then minus 15% for the next 2 years, followed by a 6% return. Both investors face the same average returns, but Investor 1 runs out of money by year 18, while investor 2 still has $400,000. This illustrates how the sequence of returns can significantly impact your retirement savings. Historical returns. Using data from Portfolio Visualizer and sources like Investopedia, the compound annual growth rate of U.S. stocks is around 10.25%. Adjusted for inflation, it's about 6.04%. Dave's suggested 12% return doesn't align with historical data. For example, holding the S&P 500 for 25 years shows an annualized return range from 5.9% to 17.2%, not consistently 12%. Real-world calculation. Let's use the FICAL CPA app, a financial independence calculator, to see the real-world implications of Dave Ramsey's advice. If we take $1 million and withdraw $80,000 annually, adjusting for inflation, the success rate of this plan over 25 years is only 46.9%. If extended to 30 years, it drops to 39.8%. This means nearly half the time, this strategy fails to sustain your retirement. The real-world calculation shows that depending on such high withdrawal rates is risky and often unsustainable, potentially jeopardizing your financial security during retirement. What Dave overlooks. Dave Ramsey has often suggested better than 12% returns and insists on a high withdrawal rate. However, he rarely discloses his actual investment portfolio, which could lend more credibility to his claims. Transparency in what he's investing in would be beneficial for his followers. Instead, he promotes an overly aggressive investment strategy that might not be suitable for everyone. Dave overlooks the importance of diversification and the risks associated with relying solely on high-risk investments. A more balanced approach, considering individual risk tolerance and retirement goals, is essential for long-term financial security. Conservative investment approach. A conservative investment approach is crucial as you near retirement. This involves shifting from high-risk assets like stocks to more stable investments such as bonds, real estate, or dividend-paying stocks. The goal is to protect your savings from market volatility and ensure a steady income stream during retirement. While stocks can offer high returns, they also pose significant risks, especially in economic downturns. Diversifying your portfolio with a mix of assets can provide more stability and reduce the impact of market fluctuations. Additionally, considering annuities or other income-producing investments can provide a reliable source of funds. This approach helps preserve your capital and ensures that your retirement savings last throughout your retirement years, offering peace of mind and financial security. Dave Ramsey provides great advice for getting out of debt, but his investment advice might not be the best for everyone, especially when considering retirement strategies. You can't assume a 12% linear return, and you should be cautious about a high-risk asset allocation. The 4% rule, while conservative, provides a more realistic and sustainable approach to withdrawals in retirement. If you found this video helpful, then don't forget to hit that like button and subscribe to our channel for more amazing content. Thanks for watching, and we will see you in our next video.